In this video, I'm going to teach you everything you need to know about liquidity. We're going to talk about liquidity on the higher time frames, how to find liquidity sweeps, runs, grabs, all that sort of stuff. And, I've been trading for years. I'm an ICT charter student. I can honestly say, out of everything I've learned in technical analysis, liquidity is by far the most important thing. And if you can really understand liquidity, you're 90% of the way there, right? These markets only move for liquidity, and it's so important that you understand liquidity. And in this video, I'm going to teach you exactly what you need to know so you can start making money today. Okay, so what is liquidity actually, right? We hear about this all the time, liquidity. What actually is it? It's simply highs and lows, right? Highs and lows. Most importantly, on the higher time frames, so the daily and the 4-hour, key highs and key lows will have lots of orders there. Now, what do we mean by orders? We mean stop loss orders. Now, why is that important? Stop loss orders will have billions of dollars, right? Remember, we're on the daily chart for gold. There'll be billions of dollars at this low and this high, right? People shorting will have their stop losses here, and people going long will have their stop losses here. And by people, I'm talking about smart money. Now, smart money are large banks, large institutions, hedge funds, all that sort of stuff, who have billions of dollars, and they move the market. We don't move the market. Day traders don't move the market. Scalpers don't. It's them with billions of dollars. They move the market. And in order for them to actually get their orders filled, and what that means is for them to actually get into a trade, is they have to do business at key highs or key lows, right? That's it. That's what liquidity really is. So these markets will only move for higher time frame liquidity. And this is so important because so many people understand, key highs and key lows, but then they look at, the 1-hour key high and they think that's the most important thing, when they don't realize there's a key low on the daily chart that price is going for. And right, so we're on gold, we're on the daily chart, and we're going to look for the most obvious high or low that price is going to go for. And I hope it's pretty clear. Maybe it's a bit bigger. We're going to go for this low here. Now, why are we going to go for this low? Let's mark it out. There's lots of liquidity at this low. We know it's a key low. We know that gold's been in the bull market, right? So people have trailed up their stop losses here, here, and here, right? Some people might have had it here. But here, there's so much liquidity. There's so many orders here for smart money to target. And another thing you can do whenever you're unsure whether price is going to go for this low is just look at the order block, right? So we're going to look at this order block here. So I'm going to mark out the order block, which is just the last down close candle before the up move, like that, right? You see how price aggressively comes into it and wicks deep within it? That right there isn't really respect of an order block, right? Because what you would expect if it was a valid order block and we were still bullish, you'd expect price just to tap it with a wick and then quickly move off, right? But we don't have that. We have a massive, aggressive down close candle. And when you see candles like this and you see the candle closing into the order block and wicking deeply, that shows you there's complete disrespect of the order block. Right, we're not bullish in any way, sense, or form, right? Complete disrespect to this order block, and we've got key liquidity here. And you might hear this being called a liquidity pool, right, or whatever. The terminology is not important, but what we know is that for gold, currently, we're going to go for this key low. This key low, there's been no respect to the order block, and we've got this obvious key low. Now, what does this mean? Because so many people get this wrong. This right here is your daily bias, right? So we've already figured out daily bias just by using liquidity. We've used liquidity and we know our daily bias. Now that means when we get on the lower time frames, we're only going to look for shorts on gold. We're only going to look for shorts, right? So many people, they do this and then they start looking for longs on the lower time frames because it looks bullish. You don't do that. You only look for shorts. But, and this is so important, when we get in the lower time frames, we're going to look for liquidity sweeps. Right? We're going to look for liquidity sweeps. Now I'm going to explain more about that when we get onto the lower time frames. Okay, so we're in the lower time frames and most people understand what I just said in the higher time frames. They know we're bearish, but they always go wrong in the lower time frames. Now, why did they go wrong? Because they're not waiting for a liquidity sweep. Now, what is a liquidity sweep? And a liquidity sweep is, a liquidity run, liquidity grab, whatever you want to call it. It's the exact same thing. What it is we know we're bearish on the higher time frames. We've done the hard work, which is always on the higher time frames. We know the actual direction of the market, and we're looking for any reason to get short. Now, we're waiting for some sort of key high to be taken out because we're bearish. Now, why are we waiting for that? We know, right, and you've probably had this loads of times where you might have shorted here, right? You might have shorted at this order block, let's say. So this order block, the last up close candle for the down move, you might have put your entry right at this body here. You would have had your stop loss maybe up here, and you would have targeted maybe this wicks low, like a 3-to-1 or something, right? How many times have you had the bias right, the direction right, the price literally will come down, go straight through to your stop loss, take out your stop loss right here, and then quickly reverse? Like, how many times that happened? Because that used to happen to me all the time for years. Like, I would get the bias right, I knew exactly where it was going to go. Price would come, it would literally wick up, take out my stop loss, instantly reverse. The reason why that happens is because you're not waiting for a liquidity sweep. Now, what is a liquidity sweep? We know at this high here, there's lots of stop loss orders here. Lots of people have gone short on gold. They know from the higher time frames that we're bearish. So they've got the stop loss orders here. And I'm going to mark this out, right? Because this is so important. when price comes all the way like that, right? See this wick here? See this wick? So let me make this more obvious. See this wick? You see how it points up, literally comes out, takes out this high. Let me make this a bit more clearer. Right, comes up, takes out this high, instantly reverses it. Look how aggressively we reverse. That right there is your liquidity sweep. Right, it pokes up, takes out the high, quickly reverses. That is your liquidity sweep. And this is really important. We don't know it's a liquidity sweep until around down here, right? Because once the wick comes and takes out the high, you know, it is possible that price could have had a little retracement and continued up, right? But when we see a wick that just points up, just takes out that high, and then quickly reverses sharply, that right there tells you you've got a liquidity sweep, right? And what we really want to do is we want to enter on that retracement after the liquidity sweep. So I'm just going to mark out the liquidity sweep here, because you always, and this is so important. If you're a day trader, scalper, or even a swing trader like I am, you want to wait for a liquidity sweep before you enter, because if you don't wait for a liquidity sweep, you're going to get swept. So I'm going to mark this out, liquidity sweep. Right, and this is probably the second most important thing. Once you've got the bias, you need to wait for a liquidity sweep. Otherwise, you know, you're going to be getting your stop loss taken. You're going to be right with the bias, and then you're going to lose, and then you're going to get angry. You're going to revenge trade, and you're going to keep losing and blow your account. All these things happen to all traders, and I don't want you to go through that. So we wait for the liquidity sweep, we wait for the wick to take out the high, and then we're just looking to get short, right? And you know, this isn't a video about entries. We've got loads of entry videos on the channel and stuff, but there's a fair value gap here, right? Easy fair value gap entry that you can take, right? So you put your entry right here to make this a bit more obvious. Put your stop loss at liquidity sweep high. Now, why do we do this? We talk about this all the time. Why do we do this? Because it's very unlikely, if we're bearish and we've had this liquidity sweep, right? Because remember, price only came up here just to take out that high. That's the only reason it came up there, was just to take out that high. Very unlikely that price is going to come down all the way down here, come up, take out this wick again, and then go back down. Very unlikely. It is possible. It does. The lower the time frame you go, so if you're on the 1 minute, and especially on indices, you'll see that a lot. It's like a double liquidity sweep. But you know, for forex, if you're on the 5 minute chart, very unlikely, right? Because price only came up here just to take out those stop loss orders. That's the only reason it went up there. It didn't go there for any other reason apart from just to wick up, take out those stop loss orders, so smart money can take the other side and ride price down. So it's super unlikely price is going to come all the way up, take out your stop loss, and then reverse. So it's very safe to put your stop loss here. Very safe, right? Very unlikely that price is going to come up. And in terms of take profit, always target at least a 2-to-1. And for me, I say never more than a 3-to-1. Now, why do I say that? Because let's just at least target this low, right? Because lots of liquidity, and you ideally want to be targeting the opposing liquidity pool. Now, what does that mean? It means if you're bearish, you want to target the opposing low. And if you're bullish, I target some opposing high. Really doesn't matter, but for me, a 2 to 3-to-1 is absolutely fine. And if we target this low here, basically get a 3-to-1. Now, why do I say never to trade and never target more than a free risk reward for day trading and scalping, and even swing trading, really? Because look at this. Let's say you target a 4-to-1, right? You did everything right. You got the bias right in the higher time frame. You wait for a liquidity sweep here, right? You wait for liquidity sweep. Perfect entry. Price comes all the way down, right? So it comes like that. You enter right here. Perfect entry. 3% up in profit, and it just chops like that. And then this is the end of the week, right? So it gaps up, or it just reverses on you, right? Imagine that. Imagine how annoying that is. I'm telling you, all you need is a 2 to 3-to-1 consistently, right? I have a 50% win rate and a free risk reward ratio. I'm profitable. I can make all the money in the world, 10k a month, 100k a month, whatever, $1 million a month maybe if I get enough capital. Like, I can make whatever amount I want, right? That's all you need. Most profitable traders have a 50% win rate and a 2 or 3 risk reward ratio. And all these guys saying you need, a really tight stop loss, massive risk reward, it's a load of crap. It's a load of crap. And that's because they have a tiny win rate. If you do this, you're going to get a good win rate. And yeah, always be realistic. Aim for a 2 to 3-to-1. And I'm going to give you another example on gold too. Okay, so here's another example in gold. And this is such an important example because someone was asking me, right? And let me just make this clear, right? So right here, let me mark this out. Right here is your liquidity, and here is your liquidity sweep. Price pumps up, quickly moves down. Now, someone was asking me, let me mark this out. Someone was asking me, does a liquidity sweep or run or grab, does that always have to be a wick? Right? Does it always have to be a wick that just points up like we had in the last example and quickly reverse? No, it can be a body as long as it aggressively reverses, right? Now, what does that mean? Right, look at this, right? So price literally pokes up. I know we get a body, and then it quickly and aggressively moves down, right? And then moves up and like that, right? You get big fair value gaps in the opposite direction. And when you see that, when you see price pumps up and aggressively moves in the other direction, and it leaves lots of fair value gaps, that tells you it was a liquidity sweep, Right? It was a fake move. The only reason price went up here was just to take out these relative equal highs for easy liquidity and then quickly reversed. And we're not talking about in this video, but if you're more eagle-eyed, you'll see this low here. Once these candles close below that low, that's a market structure shift. Now, I'm not a big believer in market structure. I think liquidity is way more important, but some people do look at that. But what this is, this candle here, and you've got to understand, the overall thing. Because remember, we did all the hard work on the higher time frames. We know we're bearish. We know the key liquidity is at that key daily low, right? We're bearish and we're only looking for shorts, right? So we're operating on the lens of we're only looking for shorts. And this candle up here is just a fake little move. And I know you get a bit of a body. It's a fake move, but you gotta wait for these candles. Once you're all the way down here, right? So you're on the charts and you see this right here. Clearly you're bearish, right? Clearly this was a fake move and we strongly, aggressively moved down. We've got relative equal lows here. Nice and easy trade. And yeah, for your entry, you can either take the order block, which would be this candle here, which you just about get. Right, like this. Just about get. Like that. Stop loss always at liquidity sweep high. Like we keep saying, I'm going to keep saying this until you're all bloody profitable. Very unlikely that price is going to come up, take out this high again and reverse, right? Now, it can happen. It does happen rarely, but that's why you have your stop loss, but it's very unlikely. And for take profit, you can target this low for an easy scalp. Easy scalp. Don't do anything crazy, right? Don't do anything crazy, but just target a 3 to 1. Now, usually, if you want to take the fair value gap, right here, yeah, your stop loss is going to be wider, and you wouldn't get a 3 to 1, I don't think. Right, in this case, and you wouldn't get this low either. But you can get a really easy high probability 2 to 1. Really easy high probability 2 to 1. And, personally, if you've done all the hard work, you've done all the analysis, I would just take the easiest entry. And fair value gaps often tend to be the easiest entry possible. But yeah, that is how you use liquidity to actually trade. You use it on the higher time frames, daily in the 4 hour, find the direction that market actually wants to go to. You go onto the lower time frames and you only trade in that direction. You wait for a liquidity sweep and then you enter on that direction. And yeah, I'm going to give you more examples until you guys understand this. Okay, so we're on euro dollar, and like we did in the last example, what we're going to do is we're going to look for the key liquidity pool, right? And in this direction, or in this trade, sorry, we've been bearish, huge aggressive moves on euro. We took out this low, this low, this low. All of these lows here had key liquidity at it. Key liquidity at it. And at this point in the chart, so we're going to look for the most obvious key next liquidity pool. And if you look here, it's our next obvious liquidity pool, right? Lots of lows here on the daily chart on euro. There are billions and billions and billions worth of stop loss orders here. And the market will only move for those sort of orders, right? So we're bearish. We've got key obvious low we're going to go for. And we're going to look to short, right? Let me make this a bit more obvious. So we've got this key daily low. We're going to look to short, right, all these little opportunities we get at the lower time frames until price takes out this low. And once it takes out this low, it might consolidate like this, or it could even start to reverse, right? So we'll just wait for a few days. But as far as we're concerned, as long as this low is valid, we're just looking for shorts, and we just want to ride the higher time frame trend. And when we get in the lower time frames, we're only going to look for shorts, and we're going to wait for a liquidity sweep. Okay, so here we are on euro. We've got like key daily low. We've got London's low as well. So we've got lots of liquidity and this key liquidity pool down here, right? And we're just looking for any reason to get short, And we're looking for our liquidity sweep. Now, like, this move right here is a fake move. It's a fake move. Now, why is it a fake move? Because we did all the work on the higher time frames, right? We know we're bearish. We know the direction of the market. This right here is a fake move, right? We're not looking to buy this fair value gap here. Although lots of traders who only know about fair value gap, they know nothing about liquidity. They don't do any high time frame analysis. They're looking to buy price here, and they're hoping that price goes up and it comes straight down, takes out their stop loss, and then they're angry, right? But because we did all the hard work on the higher time frames, we're not looking for that. We're looking for short. We're looking for any reason to get short, and we're looking for a liquidity sweep. Now, this is a fake move up, and we get this high here, right? And we get these candles here that point above this high. That right there is your liquidity sweep, right? Price consolidates for a bit and then aggressively drops, right? And let me just make something clear. We only know that it's a liquidity sweep around here, right? Because price just came up, took out that high, and then quickly and aggressively and sharply shot the other direction. At this point here, once it wicks up there, I'm not thinking, oh, this is a liquidity sweep. I don't know, right, until it starts dropping aggressively, right? Because what we see here is just some consolidation here, and then once it aggressively drops down, then I know it's a liquidity sweep, right? I don't know it's a liquidity sweep until price actually shows me, until smart money actually show their hand that price wants to move down. And then again, we get fair value gaps and fair value gaps. So right here is your liquidity sweep. So let's mark this out. Right, so we've had our liquidity sweep like this, right? Aggressive move down, sharp aggressive move down. We've got our big fair value gap here. You've got an order block. The entry does not matter. And let me tell you something. The entry pattern is the least important thing. Right? If you've got the direction, right, like we've done on the higher time frames, you've got liquidity sweep. Entry pattern is the least important thing. Optimal trade entry, fair value gap, order blocks, breaker blocks, mitigation block, whatever you want to call it, whatever you want to use, all of them will work. So yeah, in this channel, we just use the fair value gap because it's easy. You can use the order block, you can use any of it. Yeah, so you put your stop loss right here, liquidity sweep. Like we always say, very, very, very unlikely that price come think about it, price come all the way down here. Right, very unlikely it's going to come all the way up, take out your stop loss, and then go straight back down, right? Especially when you're a day trader, because there's such a small time for price to actually move, right? So we've got a nice, safe stop loss. And what we're going to do is we're going to target the opposing liquidity, which is here, right? Easy liquidity right here. And you've got relative equal highs, right? So what risk to reward does that give us? Right, 2 to 1, or about 2.7. Just about get a free risk to reward ratio. But again, this is why I'm a big believer and you don't target anything more than 3 to 1. Because you might say, oh, well, it's all the way at this low. But okay, you get a 4.5 risk to reward ratio, but you've got to hold, for hours and through all the way up until Asia, really, which you don't want to be doing. Just take an easy, easy low-hanging fruit. 2 to 3 risk to reward ratio is all you need. With a 50% win rate, a liquidity sweep, higher time frame bias, you'll be fine. You'll be fine. And yeah, I'm going to give you another example. This time it's going to be in yen. Okay, so we're on dollar yen, and as always, we're on a daily chart, and you can do the exact same analysis on the 4-hour chart, but I'm just going to do it on a daily chart because it's nice and easy. And we've got this key high here, right? This key liquidity pool right here that price wants to go for. We're bullish. It's very obvious. We're respecting, these order blocks, these fair value gaps. It's all getting respected. Right? There's lots of liquidity at this high, and we know a price only goes for highs and lows. So all it does, it moves for highs and lows on the higher time frame. So we know we're bullish, we know we're targeting this key high, and when we get the lower time frames, we're only going to look for longs in dollar yen, and we're going to wait for a liquidity sweep, and then we're going to enter after a liquidity sweep. And it's really that easy. Okay, so we're on the 5 minute for dollar yen, and this is a London example, because I want to show you it works in all time frames, right? It works, in every market and all time frames. And right here is your liquidity sweep. So let's mark this out. Right here is your liquidity sweep, right? And, like we said, it doesn't always have to be a wick, right? It doesn't always have to be a wick, because right here is our liquidity sweep, and you get these little candles. You see how price comes in, you get these little tiny candles right here, and the price quickly shoots off. This right here is what some people will call accumulation, right? I don't want to make this video too complicated, but what that really means is that price right here, and because it's at a dead time. Now, what do I mean by dead time? 1:30 a.m. New York time is, Asia's ended, but London hasn't quite begun. London begins around 2 a.m., right? 2 a.m., which is around here is when London actually begins. And, 1 a.m., 1:30 a.m., because I'm in the UK, right? This is around like 6 a.m., 6:30 a.m. No one's really awake or trading at this time. So this is dead time. So price will wait, it will consolidate, it will accumulate orders, and then it will start moving during the actual session in London, right? This is Asia, and then you got London here, right? So this is why you get these little tiny candles. But this is your liquidity sweep, right? We had liquidity here. I remember we had this big move up. We're bullish on the higher time frames. And again, right here, this is another liquidity sweep, right? You see this low? See how it wicks down, instantly reverses. That's your liquidity sweep there. Right, that low, price comes down, wicks down, instantly reverses. That's the liquidity sweep. But in this case too, right, the only reason price came down here was just to take out this low and then quickly, sharply, aggressively moves in the other direction. That's it. That's the only reason it does that, right? So that's your liquidity sweep. And, it can be bodies, it can be wicks, but ideally it's about small little candles if it's a body, and then it quickly reverses. That's the key thing, right? If we don't see these aggressive fair value gaps in the opposite direction, then we're not bothered. But because we see this aggressive move in the other direction, we've got the higher time frame and bias, we've got all that in our favor. That makes it a liquidity sweep. And, in terms of entry, we're just going to take this fair value gap here. A nice, easy entry for you. So you're going to put your entry, this fair value gap here, stop loss at this low, because like we keep saying, if prices really come up, very unlikely it's going to come down, take out your stop loss, and then go straight back up. Very unlikely, because we waited for liquidity sweep. And the key thing is you're going to have the patience to actually wait for liquidity sweep, because if you don't wait for liquidity sweep, you're going to get swept. Price, you're going to do, you're going to get the bias absolutely right, like I used to all the time, but you're going to be impatient. You're not going to wait for liquidity sweep. Price is going to come down. You're going to be the one that actually got swept. It's going to go back up, give everyone else a chance to actually get in at a fair value gap here, and go straight to take profit. And you're going to be dead angry, and you're probably going to chase this move all the way up here. And as soon as you chase it, how many times has happened? As soon as you buy it, like right here, it reverses like that. And you're blowing your account and stuff, And you always want to wait for liquidity sweep, because that will avoid all this hassle, man. Let's just remove all this, make the charts nice and clean. So in terms of take profit, you've got this key daily high right here. You've got key liquidity here. Let's target at least 2 to 1, and in this case, you get a free risk to reward ratio, just like that, right? If you really wanted to, you could target a 3.2, but it doesn't matter, right? I like a fixed risk to reward ratio. Because for me, I always target a 3-to-1. 3-to-1, nice and easy, high probability setup, done and dusted. And yeah, I'm gonna give you another example, this time in GBPUSD. Okay, so we're on GBPUSD, and I hope at this point it's starting to get familiar, right? It's starting to get familiar with what we're actually doing. We're on the higher time frames, and we always do this daily or the 4-hour. You can do the weekly, but you can see the weekly chart on the daily chart, right? This low here, you could also see it on the weekly chart, and this low too, right? So it doesn't really matter. I would say the daily or 4-hour, because the weekly is very slow, especially if you're a day trader or scalper. But nevertheless, for the daily chart, we've got this key low here, lots of liquidity here. We had another key low here that price took out, but this key low here, there's lots of liquidity here, and we know we're bearish. There's been no respect of this order block and no respect of this order block. So let's mark out this candle just in case you are unsure. The last down close candle here before the opening, that's your order block, right? Just make this a bit more obvious like that. That's your order block. Price comes in aggressively, literally closes into the order block and wicks deep within it. There's been no respect of the order block, because if price actually respected the order block, it would have come in, tapped it, instantly reversed off. We don't get any of that. We don't get any of that at all. That right there tells you that we're bearish. We're bearish, and we've got this key liquidity pool, liquidity low, whatever you want to call it, right here. We know there's lots of stop loss orders, and we know we're bearish. So we're going to get the lower time frames as always, wait for a liquidity sweep, and then we're going to wait for our entry. That's simple. Right, so we're on the 5-minute chart now, and we're looking for our liquidity sweep. I hope it's pretty obvious. We got this key high here. You've also got this high here, these highs here, but let's just go for this high, right? It's pretty obvious. And let's just mark this out. This high here, lots of liquidity out here, lots of liquidity out here. So let's mark this out right here. And this is your liquidity sweep. This candle moves up, wicks through it, and then we get a bit of a body, and aggressively, sharply moves all the way down, taking out all this liquidity, and then leaves this daily low intact, right? Leaves the daily low intact. So this right here is your liquidity sweep, right? You're going to wait for this. And this is in London. Sorry, this is in New York, right? The liquidity sweep. So let's mark this out. Liquidity sweep, like this, right? So this is your liquidity sweep. Fuck's sake, if I can actually spell. This is your liquidity sweep right here. Like that, right? Price aggressively moves down, and this is during New York, right? So New York is a New York news candle. So you often get this during news. A fake move up, because remember, on the higher time frame, we're bearish. We've done all the work on the higher time frames. We know where price actually wants to go. This is just a fake pump up during news. And we come up, we wick out, take out this high, quickly move down. And as always, because we're bearish, we've had our liquidity sweep, wait for price to move down, enter on the retracement, like that. That's what we always do. That's the highest probability trade. And yeah, in terms of entry, you've got a tiny little fair value gap here, but I know some of you really like order blocks. So order blocks in this case is just the last up close candle before the down move. And let me just tell you something about order blocks. If you've got an order block, that's also a liquidity sweep that we have here, and it has a fair value gap, like it does here. And I know we've got a lot of wicks, but if you've got an order block that has a liquidity sweep, has a fair value gap attached to it, that right there is a very, very high probability order block. And yeah, let's just let's put my entry here. Right? So we're going to enter at the order block right here, stop loss at the liquidity sweep high. And I'm going to keep saying this because people always ask me this. Very unlikely price to come all the way up, take you out, and go straight down. Right? The market is not designed to take your stop loss out. It's designed to take out those with billions out, right? Not you personally, those with billions. So we can enter at this order block like that. So for take profit, we're going to target at least 2-to-1, or in this case, nice, easy 2.3 risk to reward ratio. I know you get your 3-to-1 like that, but at most you're going to be targeting a 3-to-1 like that. Nice and easy. And this is how you actually trade with liquidity. You wait for liquidity on the higher time frame, so you wait for it to be obvious what daily high or what daily low we're going to go for. You only trade in that direction on lower time frames. You always wait for liquidity sweep, wait for a fair value gap, or any sort of entry, order block, optimal trade entry again. So for those who don't know, let me just mark this out very quick. The optimal trade entry is you get your Fibonacci tool, because we're bearish, we do it from the high here all the way to the low. And me personally, I enter the 0.705 level. Right, you get in your Fibonacci settings like this, like it. Pause the video. This right here is what you really need, 0.705 level. And yeah, take a screenshot of all these, because this is what I use personally. And yeah, for entry, enter right here. And the reason why I love the optimal trade entry so much is you don't have to think about what fair value gap, what order block do I take, right? It's so easy and obvious. And for me, I always target 3-to-1, right, like that, right? Like this, nice, easy, high probability trade. And I do this on the 4-hour. Literally, this is exactly what I do on the 4-hour. I wait for a liquidity sweep, optimal trade entry, obvious liquidity, and because it's a 4-hour, this liquidity is always significant, and it's nice and easy. But when I was a day trader, it's the exact same thing I used to do. And Yeah, you know, the entry pattern is the least important thing. As long as you've got the bias right, which you determine with liquidity, and you've got liquidity sweep, you'll be fine. You will be fine. And yeah, I'm gonna give you one last example because I really want you guys to get it. And if you're watching this far, you guys deserve a treat. I'm gonna give you in indices this time. Okay, so we're on US30, Dow Jones, whatever, and this works on futures, by the way. A lot of people ask me, it works on futures, it works on, you know, CFDs, forex, works on stocks too, by the way, it works on crypto, it works on all markets, because all markets only move for liquidity, right? You know, all markets, crude oil, all of it, all only moves for liquidity. And that's the only reason these markets move. And yeah, obviously, you know, the bias is really easy on that, right? We're in a bull market, and we've got this key high here, this key high right here, and if we were bearish, this order block right here is the last up close candle for the down move. Price would have respected it. And by respect, I mean price would have literally just tapped the wick and quickly moved down. And if you look here, it makes it more obvious. You see how price touches it with a wick, comes down, kind of respects it. Now, that right there isn't respect, because you need to wait for a few more candles. But if price did do this, if price tapped it with a wick and went like that, that right there would tell me that we're bearish. But because we're closing aggressively for it, there's no respect to the order block. That high right here, which is all-time highs, is very obvious for Dow. And yeah, we're going to get lower time frames, wait for liquidity sweep, and then we're going to enter on a fair value gap or order block. Doesn't really matter. Okay, so we're on the 5 minute for Dow, and we're just looking for any sort of liquidity sweep. And what's really important for indices, and this is so important, is that you know, you don't really want to trade till 9:30, but 9:30 a.m. Eastern, so when the stock market actually opens, that is always a fake move. It's always a fake move. It's just there for liquidity sweep. Now, it doesn't look like a liquidity sweep in terms of, it's not like forex where it's like a little, let's just imagine we're bearish where a little high gets taken out and it quickly reverses. It's not like that with forex. With indices, what it tends to be, because we're bullish, is, so let's say we've been going up, and this is a 9:30 a.m. open, let's suppose. It's like a fake move, like a really aggressive fake move, and then price comes all the way up like that. Then it usually retraces 10 to 11 a.m., continues up, takes out whatever key liquidity, let's say there's some key daily high, and it'll start to reverse in the PM session, or it will just consolidate. Like that's what indices tend to do. And this fake move, this fake 9:30 a.m. move, is like a Judas swing, whatever you want to call it. It's a fake move designed to get retail traders going in the opposite direction. It generates liquidity. And that's how you trade indices, right? You always avoid the first 30 minutes. But what you can see right here is this fake move. Remember, we're bullish on the higher time frames. We've done all the hard work. We're operating under the lens like smart money is. We're only looking for any reason to get long. Right? We're not looking for any shorts. We're only looking to get long, right? And this move right here is a fake move. Around here, you've got some liquidity here. But like, if you look at the wicks, right, the wicks do the damage and the bodies tell the story. Now, what does that really mean? It means the wicks are usually stop runs. That's what they usually are. And this low right here, there's lots of liquidity, because if you look at it, this is like the end of London. You get this large move up, then you get your retracement. So let's mark this out. Right, like this. Like that. This right here is your liquidity sweep. Right, liquidity sweep. Let's mark this out. Liquidity sweep. We always wait for this. And the indices, you gotta very, very careful, because indices can be very aggressive during the 9:30 a.m. open. And for entries, because for indices, right, and this is so important, indices are best off traded on the 1 minute really for futures. But if you're going to trade it on the 5 minute chart, I've found is you don't really get a fair value gap. I know you get it here, but it kind of gets filled before 10 a.m. Eastern, and it's not really that good. For me, I'm a big believer in order blocks. I really like order blocks indices, because if you've got the higher time frame bias and you've got like a big strong order block, now that order block's quite high probability. And again, the order block's also a liquidity sweep, and it's got like a little fair value gap in. But this fair value gap's already filled by 10 a.m. So what you're going to do is you're going to enter on this order block. And let me just tell you something about order blocks really quickly. And this is a gem, right? As soon as price, and because we're bearish, so this the last down close candle for the up moves your order block. As soon as this body closes above that candle there, as soon as it closes above it, that right there makes it an order block, right? As soon as the body closes above it, that makes it an order block. Not the wicks, right? Remember, the bodies actually tell the story. The body is actually smart money, right? Not the wicks, but as soon as the body closes above that candle there, that's an order block. That's a valid order block. And you see here, the wicks here are only for the liquidity sweep. But what we're going to do, enter on the order block. We're going to enter at 10 a.m. Eastern, right, for indices, because we don't enter before then, because it's a fake move. Stop loss at this low, like we always say, very unlikely price going to come all the way down, take out liquidity sweep, especially for indices, which moves very fast, right? 10 to 11 a.m., the 9:30 till 10 a.m. is the fake move already, so it's very unlikely it's going to come down, take out your stop loss, go all the way up, give another retracement, and then go back up. Very, very unlikely that's going to happen. It can happen, which is why you always need your stop loss, but very unlikely. And yeah, for take profit, we're going to target at least 2 to 1, like that. or in this case, a 3-to-1. And down moves a lot, right? It moves quite a lot, so you can get a lot, and you know, you can get quite a decent risk to reward ratio. Never more than the 3-to-1, like we always say. And I hope you can see now from all these examples, whenever you aim for like a 4-to-1, you kind of almost get very close, and then price starts to reverse or just consolidate. A 3-to-1 is the best. That's for me personally. 3-to-1 is the best. A 3-to-1 or a 2-to-1, right? Those two are the absolute best personally. And yeah, that is how you trade liquidity, right? That's how you actually use liquidity to make money in these markets. And out of all the things I've studied in technical analysis, liquidity is by far the most important thing. By far the most important thing. And you know, if you follow me on Twitter, you can see I can read these markets like a book. Like, I'm not even joking. I can consistently predict where price can go, like, you know, non-stop, and it feels like a superpower. And the only reason I'm able to do that is because of liquidity on the higher time frames. And what actually makes me profitable is waiting for liquidity sweep and then entering. Because, you know, when I didn't wait for liquidity sweep, I'd always get the bias right. I would always lose, and it'd be so annoying. But to summarize, what you want to do is you want to get the daily chart or the 4-hour chart, and you want to look for key highs or key lows that price is going to go for. That is your liquidity, key liquidity pool. Then you're going to get into lower time frames. It can be the 5-minute, it can be the 15-minute, it can even be the 1-minute, and you're going to wait for a liquidity sweep. Once you get your liquidity sweep, you're going to wait for your entry, which could be an order block, fair value gap, optimal trade entry, or anything else you like. And you're going to aim for a 2 or 3 risk to reward ratio, nothing more, and ideally nothing less. And yeah, that's all you need to be a profitable trader. It's really all you need, and that's how you trade liquidity. But yeah, if you want to learn more about trading, you know, you want to learn about different trading models, backtesting, journaling, psychology, all that sort of stuff, I've got a course in the link in the description below. And other than that, please like, subscribe, leave a comment for the algorithm, and I'll see you guys in the next video. Peace.